Hello, everyone. I'm your host, Ibrahim San, and welcome to yet another episode of RHB Money Chat, where we provide you some tips and insights into how to better manage your finances. Joining us this week is Dr. Sailesh Kumar, the Group Chief Economist and Head of Market Research at RHB Bank, who will be sharing with us some insights on the 2022 mid-year global market outlook. Dr. thanks again for taking the time to speak with us today. To give you a little bit of background, or to give everyone a little bit of background, the S&P 500, Nasdaq, and Euro Stocks 50 have incurred year-to-date losses between 13 to 23% losses. We also understand that there was a buying the dip moment or strategy in play with suggestion to invest in stages. The US Fed and other global central banks, including here in Malaysia, have begun to rein in on inflation, and the narrative on an aggressive interest rate hike has spread across the globe, led by the US Fed. And of course, China is seen as easing regulatory crackdown on internet platform by calling tech execs to discuss about digital economy, while authorities vow to support job markets, lockdown affected sectors with economic friendly policies, all this in efforts to regain investors' confidence. China COVID-19 lockdown is also expected to ease by June this year, paving the way for a closer and greater economic recovery. So, Dr. To kick things off today, maybe we can start with your view on the global equities for the remainder of 2022.
So for us, there has been no significant changes on view in terms of the asset allocation for 2022 and the buy on the dip strategy in the equities world. Since we last spoke, I guess, and that the buy on dips really is in the stages. As you know, one doesn't buy all at once. So the global asset allocation view remains at overweight equities, market weight fixed income, and underweight cash. So we have, to be brutally honest, been caught by surprise by the reversal of the equity markets in April and May after bouncing in March. That has been somewhat of a surprise for us. And the main reason has been the pickup in 10-year bond yields in the US above 3%, closing in on 3.2%, which caught us by surprise. We thought 6 to 3% or a little bit below that, but it basically eclipsed that, and that had been one of our downside assessment to our view, along with the idea that global commodity prices would reverse course and go up again, oil prices in particular breach through one in terms of Brent. That didn't happen, and that basically the Ukraine Russia conflict would start impacting market sentiment again. That didn't happen. So the funny thing is, one out of the three downside risks materialized, which was basically a progression to 3% quite rapidly. The other two didn't materialize, but that ended up being the most important factor behind us being caught by surprise of the sell-offs, return of sell-off in equities in April and May. Having been through that phase, having been through that pain trade, as we like to call it, in the market, we don't see any reason right now to change any views, whether it's the 2022 global asset allocation view or the buy on dip strategy in stages view. Now that basically equity markets across the world, in many parts of the world, are looking very basically cheap on an equity premium perspective. That would be my short answer.
Okay. You were mentioning just now that buy the dip strategy, of course, is done in stages. Given the recent correction from global equities, particularly in the US market, are we at or close to a period to consider it second tranche of buying the dip?
Yes, that's right. And this tranche will be significantly more, I would say, than in the first tranche where we had highlighted that we would like to start buying on the dip in the U.S., India, and Southeast Asia in early second quarter. The second stage is now. That's our stance, and that can be a lot more significant than in terms of the early second quarter buy on dips.
Moving away from the US, what are your thoughts on just a quick overview that is on your thoughts on India? Asia in general, and of course Southeast Asia?
So we remain bullish on India because primarily because we remain in the camp of being negative on China. This is despite the idea that we are, from our own indicators, in-house indicators, we are seeing the manufacturing sector starting to stabilize. With Sunday's announcement, which we thought would happen later, in the third quarter, it's a surprise for us, but a good surprise, pleasant surprise. The COVID-19 restrictions are going to be basically reduced from June onwards, and the whitelist, in terms of companies needing to be on some whitelist to operate at 100%, that's no longer necessary from June onwards. That's a positive development, but nevertheless, the three main issues linger for China in terms of markets and economy. The first is basically the Western alliance being still very much very negative in terms of their stance towards China. The domestic regulatory risks remain. And third, one never knows what other geopolitical risks, such as any conflict in the Strait of Taiwan on back of Ukraine Russia conflict. What was China's policy stance from a political perspective going to be? So that keeps us cautious. And if that is the case, then that allocation of capital, which you would normally do in China, we would basically reallocate it to India, as we have been all year long, anyways. Right? I was just in India on home leave, and also 1 week work from home, just to share with all your viewers. And the three main catalysts in terms of China, Indian equity markets is that we think that inflation will peak, much like in the rest of Asia, in sometime in this third quarter, and that basically the RBI, the Reserve Bank of India, the central bank over there, is starting to move towards a tighter monetary policy stance, which is good. For reining in inflation expectations, outlook for growth looking pretty good. I think we kind of have been, at the trough of this cycle. I would say, and third, basically, some of the political risk premium that was being built into the market by foreigners as we approach the state level elections, the first half of the year, that's basically gone. So we should see most of what has supported the Indian equity market this year, to some extent, has been domestics. We should see a resumption of foreign capital inflows into the equity market, and that would also obviously stabilize the currency, which has been hit fairly hard against the dollar in this first half of the year. In other parts of Asia, there's no change in our view. We continue to think that essentially, if Southeast Asia being still fairly defensive. Don't get me wrong; we're not in a blue skies environment by any means right now, right? Nor have we been propagating that view. There are a lot of challenges out there, and in this environment, it's still the case that you can make a case for Southeast Asia being defensive in nature, for outperformance in this part of the world. So for us, outperformance in this part of the world in Asia is Southeast Asia, India, and we have also a few weeks back highlighted that the Korean and Taiwanese equity market would delink from China because it has been hit fairly hard for a better part of this year, and that's also happened. So in North Asia, if you because you need some exposure to North Asia, you can't go to completely zero because Southeast Asia, India cannot take up the entire allocation of Asia. Then in North Asia equity markets, it would be Taiwan and Korea as our plays, as we think that in U.S. markets with the rebound in sight, sustained rebound, the Nasdaq would lead us out of this doldrums or big sell-off, and will carry with it the Korean and Taiwanese equity markets being tech intensive, as all of you know.
Okay, we're talking with Dr. Sailesh Kumar, the Group Chief Economist and Head of Market Research at RHB. For our viewers, if you want to ask anything, do leave your questions in the comments below, in the comments box. Our financial experts will reach out to you and will address your queries in good time. Dr. Sailesh, Dr. let's go back to what we saw in the first quarter of this year. S&P 500 earnings, S&P 500 earnings grew 9.1%, and analysts projected future earnings to peak in the second quarter for this year. Are you positive on US corporate earnings beyond the second quarter? That being said, are there any preferences on sectorial areas that might be of interest to you? Maybe technology, financial, consumer, maybe oil and gas, REITs, and etc. Do you think that you prefer in the perspectives of earnings beyond second quarter for this year?
Yeah, so second quarter clearly will be impacted by essentially quite a bit of pickup in commodity prices. We will see basically from the bottoms up and top down, we're already seeing a slowdown in the US economy, right? So what you should get on a year-on-year basis is that earnings actually decline. That's the idea. And then what will happen is that markets will become very pessimistic and start downgrading second half earnings to the idea with the idea that a recession is upon us in the United States, which our core macro view remains unchanged. 2022 is not a recession year for the United States, nor is it a stagflation year for the U.S. Why the trough will be in the second quarter is that our view that the that inflationary pressures in the U.S. economy will peak in this first half of the year and recede in the second half of the year is very much on track. The most recent data that we're seeing on April, let's say core PC inflation, headline inflation, whatever metric you look at, it's a month on month, the momentum is coming down. Import price in the US coming down. Our supply chain indicators suggesting congestion is coming down. With China, supply chain issues probably likely to recede in the second half of the year. Bottom line, without boring you with all the gory details, inflation pressures subside in the second half. And essentially, what that means is that real growth, in terms of real GDP growth, starts showing signs of stabilization. And with inflation coming down in the second half of the year, it means that the likelihood is that, in fact, earnings surprise hot on the upside in the second half of the year. As you know, the earnings data releases lag, right? And the downgrades lag the cycle. What is going to be critical besides earning to focus on is that the 10-year bond yields starts basically declining as it has been after hitting a peak around 3.2% range. We're now trading around 270 and change, starts basically tracking below these levels. And that's going to be a very big oomph, as I like to call it, a push factor for US markets and global markets in terms of risk sentiment to improve. So for us, the peak bearishness in fixed income, we just wrote a note on Friday about that. It's behind us, and the dollar basically is going to waver now in terms of its strength against Asian currencies. All very good signs for risk sentiment going forward.
I think the gory details are also important for us to unearth and understand. So specifically, I want to ask you about REITs, alternative assets. Do you prefer global or Asian REITs, or both, and perhaps why are you preferring one over the other?
So I forgot to answer one of your questions, which is a sector view, right? So, for example, in the United States, yeah, so basically tech remains at the top of our list. The banks and consumer remain at the top of our list. As you can see already, that we're seeing some signs from a technicals perspective that the Nasdaq starting to show signs of bottoming out. Never say never in markets, but it seems like that's where we are. And some of the big names, I can't talk about individual securities, but yeah, I'm sure all of you are conversant with what I'm basically saying. Implied is that some of the big banking sector stocks in the United States are starting to show signs of rebound, as are the consumer stocks. So we've seen net inflows into consumer funds in the U.S. recently. These are all very good telltale signs. Your question related to REITs, I think that where basically the opportunities are going to be more, I would say, concentrated at the global level rather than in any individual specific like Asia as a whole. The trouble in Asia right now we're having is that inflation is lagging the US cycle, meaning the peak of the inflation cycle over here in most parts of Asia is in the third quarter of the year. So we have a bit to go as basically, markets continue to price in higher interest rates, which are not going to be helping in terms of taking comparing those to the yields on some of the REITs. So basically, the U.S. REITs would be probably the area in the alternative space to be relatively more invested in. That's how we would posture.
Okay, with key global banks raising or about to raise its key benchmark interest rates, do you feel that the repricing of growth stocks are in the air, particularly for developed markets? Are they fully priced in your opinion? Jerome Powell does not rule out an additional 50 basis points hike in June and July, while some committee members have expressed further support for a further 50 bips hike. The fallout from a very hawkish Fed was mentioned as one of the key risks of 2022. What do you think about all this?
So our assessment all along has been, I guess since the month of April, if I remember correctly. I guess I'm writing too much for me to remember every single report I've written. But the bottom line is that we had expected that the Fed would turn less hawkish by third quarter because inflation would have peaked in the first half and growth would start showing more durable signs of a slowdown in the second quarter of the year. However, if one looks closely at the minutes to the May 5 FOMC meeting, which were released on May 26, the Fed is starting to guide towards pivoting already. We've not, I wouldn't say completely reversing course, but pivoting to a more less hawkish stance where the 50 basis point hike you mentioned at the June meeting and July meeting is baked in the cake and already priced in by the front end of the US curve anyway, as is basically the order of magnitudes of quantitative tightening that has already been guided by the Fed. We think that we end up the year around the 1.75 to 2% Fed funds rate by year end, maybe a bit higher, but not close to the from what's being priced in by the market at around 250, 270. It differs by day, but around 2.5 to 2.7% is what's being priced in by the year end. So, bottom line is that we are at the turn in the sense that peak hawkishness of the Fed is behind us, and now we have to look for the guidance that the hawkishness of the Fed actually third quarter of the year and from September onwards, September FOMC meetings onwards, it's very unclear whether they'll want to hike 50 basis points at successive meetings, and that's also why we have it. We on Friday wrote a note that basically the opportunities in the fixed income are also coming forth.
The issue is, of course, central banks aside, what are your latest thoughts on Russia Ukraine led inflation? Are there any other market risks to take note of? Is stagflation still out of the picture for this year?
So stagflation for us is clearly out of the picture for this year. What I can tell you from looking at stagflation periods, uh, I would say since the 1930s, as it relates to, let's say, the U.S., right? It's not applicable to Asia in the first place. It's mainly related to the U.S. and the developed world. Is that very few instances, and from what we are seeing, and it takes a lot to generate those stagflation prints anyway. So we don't think that we're in going to approach that even closely in 2022. And what that means is that, as you alluded to earlier, that the growth oriented stocks have been hammered quite quite a bit, and value has outperformed. Is we should see a reversal of course where growth starts outperforming value, broadly speaking.
Okay, specifically on global asset allocation, are you overweight on equities and alternative assets? What's the view on market weight fixed income, and whether or not you're underweight on cash? Do you think are these views poised to change, generally speaking?
For the time being, now that we've been through the pain of bond yield surprising us on the upside in many parts of the world, equities basically declining significantly beyond what we had expected in the second quarter of the year. having been through that pain trade, for us to reverse course or change that allocation at this point of time, now that the sell-off has happened, would be quite injudicious, if there is such word in the English language. We don't think there's a opportunity right now
You
for
can
to change. Mm.
you can create words all along, Dr. Ja, no problem. Shakespeare did it. I'm sure you can too.
Yeah, that's true. You would probably, if Shakespeare was alive today, and observing what is going on in the world, it's a comedy of fools. Yeah.
Yeah. Any final words of advice for our investors, Dr. Ja?
So the final word of advice is that, the idea is that we are not in a blue skies environment. The Ukraine Russia related risk it makes nice headlines in the world, right, on the Western media. But to be objective, it really hasn't impacted the data in terms of growth, nor has it impacted inflation. And the reason why, as we have highlighted all along, is that the Chinese and Indians would be supporting Russia in their in their exports of oil and other commodities. That view has come in. The 150 to $200, $300 per barrel oil price hasn't materialized at all, as what many analysts had forecasted as a result of the fallout from Ukraine and Russia. So the key, we're not blowing our trumpet. Don't get me wrong, we're not blowing our trumpet at all. But the key lesson learned, and we have quite a bit to go for 2022, so I don't want to basically be too aggressive on this. But the key message really is, please understand the geopolitical situation, how it will evolve, not what your own political beliefs are, right? That's not, if you're investing and trading, your political beliefs don't matter whatsoever, okay, or your philosophy. It's what you think will be the geopolitical environment. And all I gave you was my take since basically the first quarter, that the Chinese and Indians will come to the table and help Russia. It's a politically sensitive statement, but nevertheless, I'm in the market, and that's what it is, and that's worked out. So that's the lesson learned. Think with your brain. Don't think with your heart. The third key message is that in periods of stress, it's worthwhile to step back, and think, is this the time to really buy? And for us, the idea of letting go of first 5% or so of any rally in any market is worthwhile, because the risks at this point of time, or during these periods that we've seen in April and May, have been extremely high. So the message really is patience is warranted. So we were nibbling through the second quarter. It's not worked so far, and so we've had to basically compensate by probably increasing our nibble, because we've gone below the levels that we thought, and to basically do that cost averaging as you would like. So you got to have a little bit of courage now to nibble a bit more if you have engaged in the market in the early part of the second quarter. That's the way life works, unfortunately. So those are my key
Thank you.
conclusions.
It's actually quite useful because it's not that easy for people to look at the raw data and appreciate the objectivity of it. Normally, people tend to work on sentiment, and sentiment tends to not necessarily tally up with the data. Those are very sound words of advice, Dr. Ja. Again, for our friends out here that is watching this conversation, if you'd like to find out more about the 2022 mid-year global market outlook, please do leave your comments in the comment box. Our financial expert will reply to you. Stay tuned for the next session of RHB Money Chat. And until then, thanks very much. Have a safe week ahead. And of course, keep yourself productive.